Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we talk about the simplest and probably most important line on the balance sheet, cash and cash equivalents. We will see what counts as cash, what counts as cash equivalent and what does not, how it appears on the balance sheet and cash flow statement, and a few traps and controls to be aware of. So, what is cash and why this line really matters? Cash is the oxygen of any business. You can have revenue, assets and even profit, but if you run out of cash, the game stops. That is why one of the first things people look at are how much cash does the company have and how quickly does cash move in and out. So let's define clearly what sits inside this line. When we say cash in accounting, we mainly mean physical cash that belongs to the company, for example petty cash in the office. Current accounts and demand deposits at banks. That means current accounts you can use on demand with no major restrictions. So if our Apple shop has 300 in cash register and 4,700 in bank account we can use tomorrow, that is 5,000 of cash. And typical journal entry for a cash sale of our apples would be debit cash 5,000, credit sales revenue 5,000. And when we spend cash, it will be a credit entry for cash. For example, if we pay cash for purchase of apples, the journal entry would be debit inventory 3000, credit cash 3000. But not everything is defined as cash. There are also some categories which are close to the definition of cash and which are called cash equivalents. What are they? Cash equivalents are the assets which are short-term, means available for us on a short notice. Highly liquid investments means there is an active market for them and there are others who would always like to get them from us. Readily convertible into a known amount of cash. We can easily exchange our cash equivalents into cash and for a known and clear amount of cash. Subject to insignificant risk of changes in value means we can more or less very accurately determine how much cash we will get at a given point of time. In practice, most companies use a simple rule. Original maturity should be of 3 months or less from the date they bought it. Typical examples of cash equivalents would be short-term deposits, certain money market funds that behave like cash, short-term government bills close to maturity. So, a 2-month deposit that you can break at any time with minimal penalty will usually be a cash equivalent. Anything longer or riskier starts to look like an investment, not a cash equivalent. And before we move forward, if you find our lesson useful, please take a moment to hit a like button, subscribe to our channel and leave a comment. Your support is very important to us, and thank you for being with us. So, what is definitely not a cash equivalent? Things that cause common confusion and usually are not cash equivalents are equity investments, for example shares in other companies. Long-term deposits, for example 9 or 12 months deposits, unless you can genuinely cancel them with no significant penalty and policy supports it. Risky or volatile instruments, for example crypto, long-term bonds or shares in a money market that can move a lot in price. Inventory, even if you think it is as good as cash, it is not cash until it is sold and cash is collected. These items are investments or other assets, not cash equivalents. On the balance sheet you usually see a single line, cash and cash equivalents, sometimes with small breakdowns in the note, cash on hand, bank balances, short-term deposits and other cash equivalents. And here is a quick sneak peek in how cash looks like in real-life accounts. The important point is that this line should represent amounts that are available or almost immediately available to run the business. And now, two important details. First one, bank overdrafts. If your bank account is allowed to go negative and you actually use that facility, under many frameworks it is a short-term borrowing, not negative cash. It is usually shown in current liabilities as bank overdraft. But in some financial statements, if the overdraft is part of a day-to-day cash management, it can be netted into cash and cash equivalents. The accounting policy or notes to the financial statements should explain that. And the second one, restricted cash. If cash is restricted for a specific purpose, for example held in escrow account as a rent deposit or pledged as collateral, You still call it cash, but you show it separately as restricted. It is not part of the free cash you can spend tomorrow. And now let us briefly connect the cash entries you already know from other lessons. We start with cash sale. The journal entry is typically debit cash 1000, credit sales revenue 1000. When we collect trade receivables, we record debit cash 1000, credit accounts receivable 1000. When we pay our supplier, we record the following: debit accounts payable 600, credit cash 600. We can also move the cash from our bank to a 2-month deposit. That would qualify as cash equivalent. And the journal entry would be debit short-term deposit, still in cash and cash equivalents 5000, credit cash 5000. These are within cash and cash equivalents, just different pockets. And now, what happens when you hold cash in foreign currencies? For example, US dollar on a euro reporting balance sheet. Here you do the following. Record it at a spot rate when received, means the current exchange rate. At each reporting date, measure at a closing rate. And recognize foreign exchange gains or losses in profit. Let's have a look at an example. You hold 10,000 US dollars. If the euro strengthens, your euro value drops, as you can exchange your $10,000 into less euro, and you record a loss. If the euro weakens, it's the other way around. Your euro value increases and you record a forex gain. Let's imagine you got $10,000 when the rate was 1.1. Then you would have had 9,091 euros. At year end, euro goes up to 1.2 versus dollar, and 10,000 US dollar are now worth 8,333 in euro. So you will have 9,091 minus 8,333 equals 758 forex loss on your US dollar balance. And to reflect this forex loss, the journal entry would be debit forex loss 758 in the income statement, and credit cash and cash equivalents 758, a decrease in cash balances on the balance sheet. When US dollar recovers in value, you would record forex gain. For example, debit cash and cash equivalents 758, credit forex gain 758. So, where is the place of cash in a cash flow statement? The cash flow statement explains how you moved from opening cash and cash equivalents to closing cash and cash equivalents. Cash flow statement is all about cash and shows you how exactly you have got the cash you currently have. You can have a look at a separate video for that, link in the upper right corner. But as a brief summary, cash flow had 3 sections. Operating activities. This reflect day-to-day business. For example, collections from customers and payments to suppliers. Investing activities. Buying and selling long-term assets, for example, equipment, vehicles, but also including long-term deposits and investments which do not qualify as cash and cash equivalents. And financing activities, loans, repayments, dividends, share buybacks. And only items that qualify as cash or cash equivalents sit in the opening and closing totals. Moving money between different buckets which are still cash or cash equivalents does not change total cash and cash equivalents and is not appearing on the cash flow statement. Now, a few common mistakes when handling cash balances. The first one, including long-term deposits in cash and cash equivalents when they are really investments. The next one, forgetting to separate restricted cash from free cash. Treating overdrafts as negative cash without checking if they should be shown as borrowings. Holding risky instruments cash-like when their value can move a lot. Ignoring forex remeasurement on foreign currency cash. If you are ever unsure, ask 3 questions. Can I get the money almost immediately? Is the value almost fixed? Is the original maturity 3 months or less? If not, it is probably not a cash equivalent. Here are a few simple internal controls and good habits for real life. Always reconcile bank statements to the accounting records. Keep petty cash under control and count it regularly. Use segregation of duties. One person shouldn't handle both cash and bank reconciliations. Document which instruments qualify as cash equivalents in your accounting policy. And now let's quickly recap the lesson. Cash is coins, notes, and demand deposits. Cash equivalents are short-term, highly liquid, low-risk investments, usually with original maturity of 3 months or less. These items appear together as cash and cash equivalents on the balance sheet and bridge opening to closing cash in your cash flow statement. Watch out for restrictions and overdrafts and reconcile often. That is cash in a simple language. Hope it helped understand the topic better. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next video. See you soon and keep those debits equal to your credits.